For you as a fund manager, when you look at this, plus the China slowdown, plus the mini emerging market right that we've had, and we're only 2 months into the year, what is the dominant force? Are you concerned that this Ukraine situation, we are on the brink of war? That's what we're being told. How much of a concern is that to you as a fund manager?
I think the comments earlier were very interesting in the sense of obviously Russia has a right under the treaties to be in Crimea till 2042, and it's asserting that right. The wider question is what they do with sort of whether they move into the eastern part of Ukraine, and that will be a completely different, I think, magnitude of events. So I think we have to watch carefully, not jump to too many conclusions at this point. But I think it's an understandable move from Russia, exercising a little bit of muscle in the region. So we have to see, what the repercussions are from the debates.
Let's move on, because in the backdrop we've also got China, we've got growth slowing, we've got the Chinese authorities meeting this week to tell us what their growth targets are going to be for 2014. How important is that to your investment strategy this year?
I think it's very important. It needs to be a very strong, stable part of the emerging market story, and it's interesting, good to see the 7-day rates coming down last week to much more normal levels. I think that the rebalancing is a great potential for China. It can't just be export-driven. It has to see a growth within the social areas of the economy, health, education, environmental expenditure. So there's lots of avenues for the authorities to pursue in terms of growth. It just is going to take time and not necessarily be a smooth ride.
Talk to me, we touched briefly on the commodity story, and obviously China plays in very, very heavily to that. Talk me through your thinking on the industrial metals and the precious metals. I know we're seeing money move into gold. Some people say it's based out, but talk to me about the bigger context of commodities.
Well, the bigger context is that the part of the China story is a rational allocation of capital within post-2009, the big capital spending plans. That's being scaled back quite dramatically, and that's those investments in very marginal mines and in the country has really disrupted the whole base metal market, and I think we're much more positive about the longer-term picture, because that spending is starting to be scaled back. Those marginal mines are starting to be shut down. Marginal steel mills are starting to shut down as well. So from an environmental perspective and from a cost of production perspective, I think you'll see a recovery, especially in the high-grade ores out of Australia, and those companies that are providing those high-grade base metals, they will start to do better as well.
Chris, talk to me. I want to talk about equity. I mean, we've got the China story, we've got Ukraine. This week we get a data sweep from non-farm payrolls in the US and central banks. But there's a great article this morning in the FT that talks about US equity markets, margin trading, margin debt is up by 20%. It's slapped all over the front page. And this is higher than we had at the peak of 2007. I mean, that left me quite shocked that margin trading is now way above, 20% above where we were at the peak of 2007. Any thoughts on that?
Well, I think there are areas of the market which are really beyond explanation. I mean, there was I read an interesting article, similar article over the weekend about a comparison with the tech bubble in terms of some of the ratios that are being used, valuation methodologies for companies like WhatsApp. And I think there's a lot of very high degrees of speculation in certain parts of the market, especially in the small cap area, and obviously in the new media area. So that is a little concerning. And when I look at the market reaction this morning, I would say it's relatively complacent, and that is a concern to me, that complacency still exists. And it'd be interesting to see how the market reacts in the US today. I wouldn't be surprised if it initially opens lower and then moves up.
I mean, where are we now? Let's have a look at some of the European equity markets just to keep our viewers in touch and try and put this in context. London down 1.25%. We've got Paris down 1.7%. The DAX is off 2.3%. You say that's a rather complacent reaction. What do you think is a I suppose, a defined response. I don't know what the right word is. What do you think the right response is? If 2.5% isn't good enough for you on the downside, well, let me just cut through all the techno crap.
Yeah.
What is?
Well, I just think
should we be down 5%?
I think it's, it's a good question. It just seems to me that 1.25% on the UK, which is very dependent on the supplies of the whole of Europe is very dependent on the supplies of gas from Russia via Ukraine.
It's a huge issue.
Yeah, it's a huge issue, and to be down 1.25% on the back of that, it's pretty complacent.
And I'll tell you what, ARM Holdings, Aberdeen Asset Management and Hargreaves Lansdowne are the biggest losers in London. I mean, it just doesn't say that fund managers like you out there are overly concerned about this.
Yeah, I think that's. I think we're trying to sort of assess the economic impact.
Right.
And I suppose the initial response is it's not a big market for either exports or imports. It's the gas question is probably the most pressing.